Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Rowe Price was founded in 1937 by Thomas Rowe Price Jr. in Baltimore. He pioneered growth investing, buying businesses for long-term compounding rather than short-term value recovery plays.
Today, the firm manages approximately $1.5 trillion in assets under management, with the majority concentrated in U.S. equity and target-date retirement funds serving defined contribution plans.
CEO Rob Sharps took over in 2022 after leading investments for over a decade. He inherited retirement distribution strength along with headwinds from active management outflows accelerating across the industry.
Retirement plan assets differ structurally from discretionary mandates. Participants rarely withdraw 401k assets, and automatic contributions mean AUM grows with each paycheck, independent of market conditions.
CEO Rob Sharps took over in 2022 after leading investments for over a decade. He inherited retirement distribution strength along with headwinds from active management outflows accelerating across markets.
The effective fee rate sits around 43 basis points, meaningfully higher than passive alternatives. Rowe Price commands that premium because of its performance record in select equity and fixed income categories.
The 2022 Oak Hill Advisors acquisition moved Rowe Price into private credit and alternatives, targeting institutional capital that commands higher fees and is less susceptible to passive fund competition.
The dividend aristocrat status is one of Rowe Price's most distinctive financial characteristics. 39 consecutive years of dividend increases places it in elite company among financial services companies globally.
Operating margin runs around 35%, which is strong for an active manager. The business benefits from operating leverage as AUM grows with markets while costs remain more controlled.
The balance sheet is exceptionally clean by asset manager standards. Rowe Price carries minimal debt and holds substantial seed capital and cash, providing financial flexibility during periods of AUM outflows.
The core headwind is the secular shift from active to passive management. Net AUM outflows in certain active equity categories have pressured both revenue and operating margin relative to the 2021 peak.
Competitively, Rowe Price differentiates from BlackRock and Vanguard through active management, performance credentials, and retirement distribution depth, rather than through scale or passive product breadth.
Near-term earnings are pressured, but balance sheet strength, dividend aristocrat credentials, and retirement franchise depth give Rowe Price durability that more cyclical asset managers lack.
For dividend investors, a nearly 5% yield, 39 consecutive increases, and a clean balance sheet make Rowe Price a compelling income story in financial services.
Near-term earnings are under pressure, but the balance sheet strength, dividend aristocrat credentials, and retirement franchise depth give Rowe Price structural durability that more cyclical asset managers lack.
Near-term earnings are under pressure, but balance sheet strength, dividend aristocrat credentials, and retirement franchise depth give Rowe Price structural durability that more cyclical asset managers lack.
That's the company chapter for Rowe Price. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Rowe Price just posted the strongest beat of this entire earnings batch, 6.3% above consensus, and the stock still trades at 10 times earnings with a 5.5% dividend yield. If active management is dying, someone forgot to tell Rowe Price. Let's look at whether this is a value trap or the most overlooked quality franchise in financial services.
Rowe Price Group is a global asset management firm headquartered in Baltimore, Maryland, with approximately 8,084 employees. It manages roughly $1.5 trillion in assets under management across equity, fixed income, multi-asset, and alternative strategies, serving individual investors, institutions, and retirement plan participants worldwide.
Founded in 1937, Rowe Price built its reputation on fundamental research-driven active management. TTM revenue is $7.3 billion, up 3.1% year over year. Net income of $2.1 billion is exceptional. The company has virtually no debt, $3.4 billion in cash against only $860 million in debt, making it one of the strongest balance sheets in financial services.
Q1 2026 EPS was $2.52 versus the $2.37 consensus, a 6.3% beat, the strongest in this earnings batch. Revenue was $1.86 billion, essentially in line. The beat came from better-than-expected fee revenue, disciplined expense management, and a more favorable market environment than analysts had modeled.
On a trailing 12-month basis, revenue is $7.3 billion and net income is $2.1 billion, a 28.5% net margin that is exceptional for any business and remarkable for an asset manager navigating headwinds. Rowe Price is not struggling. It is generating substantial earnings despite the passive flow environment.
The balance sheet is fortress-level strong. Cash is $3.4 billion, debt is only $860 million, and equity is $10.9 billion, with total assets of $14.6 billion. This is a business that requires virtually no capital to operate and generates free cash flow well in excess of its investment needs. The cash pile creates massive optionality.
Operating cash flow on a TTM basis was $2.2 billion. After $130 million in capital expenditures, free cash flow was $2.1 billion. The FCF yield on the stock's market cap is approximately 9.4%, an extraordinary level for a company with Rowe Price's brand quality and track record. The market is clearly skeptical about the future.
The stock trades around 105 with a market cap of $22.5 billion. The PE of 10.4 times is the lowest in the large-cap financial services sector by a wide margin. The dividend yield of 5.54% is substantial and has grown consecutively for many years. Rowe Price has been one of the most consistent dividend growers in the S&P 500.
AUM of $1.5 trillion generates fee revenue through a blended fee rate driven by asset mix. Higher fee equity and multi-asset strategies command better economics than fixed income or ETFs. The key risk to fee revenue is a sustained AUM decline from net outflows, which has been the trend as passive investing captured market share. Q1's beat suggests the outflow pace may be moderating.
Street consensus is divided on Rowe Price. A meaningful portion of analysts maintain hold ratings, arguing that passive flow headwinds are structural, not cyclical. These analysts believe AUM will continue to erode, fee rates will compress, and the current earnings level is not maintainable over a full market cycle. The 10 times PE, they argue, reflects fair value.
The bull contingent on the street points to the Q1 beat as evidence of resilience. At 10 times earnings and 5.5% yield, bulls argue the market has already fully priced in the worst-case passive headwind scenario. From this base, any stabilization in net flows or a pickup in institutional mandates would drive a meaningful re-rating.
Alternative investments are a key growth pillar that street bulls highlight. Rowe Price has been expanding into private credit, private equity, and other alternatives, asset classes where active management commands premium fees and passive alternatives don't exist. If alternatives AUM scales to a meaningful portion of the total, it could offset passive fee pressure in core public market strategies.
International AUM is another growth lever. Rowe Price manages money for institutional clients in Europe, Asia, and the Middle East. The passive disruption trend has been slower outside the U.S., giving active managers more room to compete on performance. International flows have been more stable than domestic retail flows over the past 3 years.
The passive headwind is the core street debate. Vanguard, BlackRock's iShares, and Fidelity's zero-fee index funds have captured trillions in net new flows over the past decade at Rowe Price's expense. Every year that trend continues, Rowe Price's AUM base erodes, and with it, the fee revenue that supports the dividend. That structural narrative is why the PE is 10 times, not 20.
The valuation is the bull case in one sentence: 10 times earnings with a 5.5% dividend on a company with $3.4 billion in net cash and exceptional brand equity in active management. If T. Rowe Price stabilizes flows and maintains this earnings level, investors collect a fat dividend while waiting for re-rating that seems inevitable at this multiple.
Alternatives expansion is the earnings growth vector that passive headwinds cannot touch. Private credit, private equity, and real assets are in secular demand from pensions, endowments, and sovereign wealth funds. T. Rowe Price's institutional relationships and research capabilities translate well to these categories. Success there changes the earnings trajectory.
Share buybacks amplify the value per share as the company reduces its count. With $2+ billion in annual free cash flow and modest capital needs, T. Rowe Price can repurchase 5 to 8% of its market cap annually. Each buyback at 10 times earnings creates immediate value accretion. The combination of dividend and buyback creates a very high total return on capital.
Structural passive headwinds are the central bear argument. The data is unambiguous. Active equity funds have experienced hundreds of billions in net outflows, while passive index funds received trillions. T. Rowe Price's AUM has declined from its peak, and if that trend continues, earnings must eventually follow.
Fee rate compression is the silent killer. As investors shift to lower-cost products within T. Rowe Price's own lineup, including target date funds and factor strategies, the blended fee rate across AUM declines. Even if AUM holds flat, lower fee rates mean lower revenue. That margin pressure makes earnings decay without dramatic AUM loss.
A bear market is the acute risk for asset managers. Fee revenue is a percentage of AUM, so a 30% market decline means 30% revenue decline with minimal cost offset. T. Rowe Price's fixed cost base, compensation, technology, research, cannot shrink proportionally. Operating leverage works violently in reverse during sustained downturns.
Competition from Vanguard and BlackRock is relentless. These are the two largest asset managers on the planet, with distribution and cost structures T. Rowe Price cannot match in index funds. As long as they offer zero-fee index products, the price war in passive management pressures everyone competing in the retail channel.
BlackRock is the most powerful peer, the world's largest asset manager with $10 trillion in AUM and the dominant position in both active and passive management through iShares. BlackRock trades at a substantial premium to T. Rowe Price, reflecting its scale and its strategic position in ETF infrastructure. The valuation gap is the market's assessment of franchise quality differences.
Franklin Templeton is a closer peer in terms of business model and the passive headwind challenge. Franklin has been actively diversifying into alternatives through acquisitions, Western Asset Management, Legg Mason's affiliates. T. Rowe Price's organic approach to alternatives versus Franklin's acquisition-led strategy is an interesting structural comparison within the active management universe.
Invesco is another mid-size active manager navigating the same passive headwinds. Invesco has significant ETF exposure through its PowerShares line, giving it more exposure to the passive growth story than T. Rowe Price. Invesco trades at a lower multiple than T. Rowe Price, reflecting weaker earnings quality and less prestigious brand positioning.
Affiliated Managers Group takes a different approach. It's a holding company that owns stakes in boutique active managers. AMG's model of preserving boutique culture while providing scale services has attracted high-quality affiliates. Comparing AMG to T. Rowe Price shows how different firms have tried to solve the same passive headwind problem with different structural solutions.
Options activity on T. Rowe Price reflects the deep value investor profile that dominates the shareholder base. Implied volatility is moderate. The market doesn't expect sharp moves in either direction because the thesis is slow-moving. Most activity is in covered calls, written by income-oriented holders seeking to enhance yield above the generous 5.5% dividend.
Insider activity has been a meaningful positive signal. CEO Rob Sharps and senior executives have made open market purchases in the 100 to 115 price range. When management buys at these levels, it signals they believe the market is underpricing earnings power. Executives understand flow dynamics and fee rate pressures better than outside analysts.
Institutional ownership is dominated by value-oriented funds and income strategies. Dividend growth investors are attracted to TROW's consecutive dividend increase record spanning decades. Pension funds and insurance companies that need stable yield have been accumulating at current levels. Several major corporate employee pension plans have reported Rowe Price as a significant holding.
Key near-term catalysts are quarterly flow data and market performance. If Q1 net outflows improve versus Q4 2025, it signals the hemorrhage is stabilizing. Positive Q2 market returns grow AUM mechanically and improve fee revenue visibility. Any alternatives product launch or new institutional mandate win is an incremental positive.
Rowe Price is a high-quality franchise at a deep value multiple, because the market fears passive disruption will permanently impair earnings. The Q1 beat suggests more resilience than feared. At 10 times earnings with a 5.5% yield, the risk-reward is compelling.
The stock is priced for permanent decline, but demonstrating persistent earnings strength. Collect the 5.5% while waiting for flow stabilization or an alternatives breakthrough. If either happens, the multiple expands. If not, the dividend compounds your patience. Entry looks attractive.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.